Welcome, Jim. Welcome, Kai-Fu. Glad to have you guys here. So I want to kick things off because you guys have quite a bit in common. Both of you have sort of these meticulous theses around artificial intelligence, and it kind of informs the way in which you put capital to work, both at Breyer, IDG, and at Sinovation. So I'd love to kind of unpack those theses a little bit. I'd love to start with Jim.
Well, one, wonderful to be here at Skybridge, so it's a pleasure. And thank you for hosting. And I'll just launch right into it because I've watched some of the panels. I am 2 years into a 10-year technology investment plan around artificial intelligence. And that includes everything from AI companies in Palo Alto or Cambridge or Greater New York that are working in AI with great medical schools, doctors, to try to eradicate most forms of cancer in either our lifetime or our children's lifetimes. So in terms of optimism, I'm a pretty optimistic investor when it comes to where machine learning, AI, and if we take healthcare as one significant vertical, where there are enormous opportunities to do well, both financially and in terms of outcome, to help patients, doctors, medical institutions come to better decisions. And it's not always easy to pull these different disciplines together, whether it's medicine, chemistry, biology, neuroscience, computer science, but that's the thesis. And I also believe so much of the innovation we're going to see in AI is in and around the major academic centers. So whether it's Stanford, UCSF, Harvard, MIT, worldwide, Cambridge, Oxford,
Tsinghua,
Toronto, Tsinghua, these academic centers are at the forefront of where these opportunities will be, because so many of the best postdocs in medicine, so many of the best biologists, machine learning experts are in and around these universities. So again, this is the investment thesis, and I'll be proven right or wrong over the next 5 to 10 years, which I love, but I'm betting very big that AI, machine learning will impact everything from hedge funds to private equity to big companies such as Blackstone, where I'm on the board, as well as academic centers, financial technologies, and other big verticals. And that's why I love what I do.
So, Kai-Fu, you've actually codified your thesis into these phases, which you articulate both on the Sinovation website as well as in your book, AI Superpowers. Can you touch on those a little bit for the audience?
Sure. Yeah, I've been working on AI for about 38 years, since I was 2, since I was a sophomore in college. And it's really great to see this mature. And we saw that the biggest areas of applications are first in the area of internet, second in the area of business, third in the area of perception, and lastly in the area of autonomous robots and autonomous vehicles. So the fundamental to that belief is that there's a single algorithm that's a breakthrough called deep learning, and with associated technologies that allows a black box, a mathematical box, to take a lot of data with human guidance, and it comes up with how to do tasks within that box better than humans. So anytime you can, so one investment thesis is anytime you can categorize your problem as a vertical domain, lots of data leading to a specific outcome, and then it optimizes the outcome, then this will do better than people. Or maybe it's a task people can't even do. So that's kind of one premise. And then in the internet space, another key premise is that the more data, a corollary of that premise, right, the deep learning black box, is that given it runs on data, the company that wins is the one that has the most data. And the data has to be closed loop within the company feeding back. like Amazon collects users who click and buy, and that data is super useful to Amazon to predict other user behavior, but not that useful to anyone else. So huge amount of data. And that's why the top AI companies are internet companies, because they have the most data. And then in business applications, from banking, insurance, investment, to healthcare, we would tend to look for which hospital has the most data of, let's say you want to do MRI scans. Who has the most data, and what company can have exclusive access to that data and turn it into closed loop? Another aspect is in the third category of perception, computer vision and speech recognition. These are actually the two technologies that deep learning was proven on. So we're banking on breakthroughs in computer vision, in face and image recognition, in speech recognition and translation. These are the big ones that will be coming up. And one last thing I want to say is that another big change happening in AI is it's going from rocket science to mainstream. So not every kind of AI, but the kinds that are data science centric, it is no longer necessary to have a super PhD leading a fantastic team. If you have a team of young engineers, they can learn AI and implement it for you. So what are ways in which that can be used to create value? And the fourth wave is autonomous robot and autonomous vehicles. And that's an area where there's still rocket science going on. So that's where I think we particularly agree with Jim's thesis that the academic centers are likely to be the creator of these rocket science of AI. But increasingly, I think more value will be created out of AI going mainstream. And with the rocket science is what we love to see as scientists, but the value will be in creating value, saving money, increasing margin for traditional businesses.
So there's a lot to unpack there. And I've heard from Kai-Fu in the past that, and you even alluded to it here, that data is sort of the new oil, right? By that logic, are the BAT stocks and the FANG stocks the new OPEC? Is there sort of a consolidation of human capital in AI happening today? And is that in any way preventing the newcomer, the startup, from building real, meaningful, large businesses? Jim, as someone who's been on the board and invested in a number of these companies, what is your take?
My take is data is not the new oil, because so much of the data is structured, siloed, and unusable. Now, that's not necessarily true for the BAT and FANG stocks, but when I go to insurance companies and look at the back office, or I go to big banks, or I go to large industrial institutions, there's enormous data. But as we know, if we can't analyze that data in very thoughtful, important ways, it really doesn't matter what the sheer quantity of the data might be. And so one of the challenges as an investor, if we take private equity firms, I was at Harvard Business School 2 weeks ago where there were a number of leaders of many of our best private equity firms, and they were asked a question, is AI going to change the private equity business? And 99%, there was one outlier, said no, private equity is not going to change. Our portfolio companies may change. Technology may impact the portfolio companies of private equity, but we as the private equity business will not be changed. And I don't buy that for a moment. Private equity, like hedge funds, like major software companies, are all affected. And I'll just take one very simple example. If we take the very best students graduating from Stanford, MIT, Harvard, Tsinghua, Cambridge, Oxford, Toronto, I could go on and on, they are largely receiving offers from the quantitative hedge funds, the top private equity firms, or Google, Facebook, Apple, and they're choosing to go to one of those companies. Now again, this is not a large number. There are probably 1,000 of those graduating students per year worldwide who would be at the very top. But on the margin, whether it's BlackRock, Blackstone, KKR, Apple, Google, Microsoft, there is intense competition for this talent. And this is the talent that in many ways, coupled with deep domain expertise, will change the nature of healthcare investing, private equity investing, hedge fund investing, in some ways, I think, venture capital investing. So as an investor, I think we are at great risk if we don't recognize that there's an emerging talent pool that is forever going to change potential returns in different financial asset classes. And for me, that's very exciting. But the day-to-day recruiting of these enormously talented students, postdocs, professors is extraordinarily challenging. But that's what we get paid to do.
Definitely. And Kai-Fu, from your perspective as someone who's based in Beijing and has been historically an early stage investor, do you see these guys like Tencent and Baidu and Alibaba soaking up a lot of this talent, or is there's obviously seems to be plenty of room to grow, but what's your take?
Yeah, so first on the talent, then on the data.
Sure.
Yes, definitely the big internet companies can attract the talent, because if you're a new PhD in AI, you want a few things. One is you want a great company, you want a good package, and you want an environment which has a lot of data on which you can demonstrate value, right? Everyone wants to prove what they're doing is useful, so you want to make money for the hedge fund or help the sales on Amazon and have quantifiable numbers. So the fact that these internet companies have all this data is helpful to attract the people. Plus, it's known that the CEOs of these companies understand the value of AI and AI engineers, so people will get rewarded. So they actually don't go to traditional companies. I think the hedge funds are beginning to be attractive, would be form another set of possible hires, because that's another quantitative area. But I think, like Jim, I think there's a limited number of these super PhDs. I think the biggest issue actually is traditional companies don't really get their fair share. In fact, they probably don't get any at all. A real estate company, a traditional retailer, why would a top PhD want to work there? And if they don't work there, how is this traditional company ever going to figure out its core value from AI? So a lot of our recent energy has been in how to help the traditional companies and make money from it. And we actually think a lot of boring traditional companies can use AI. For example, with the recent RPA, robotic process automation, it's essentially basically using AI as a software running on someone doing the back office work, watching what the person does, and eventually doing a certain % of that work, thereby reducing significantly the cost. And that could be very significant. Imagine if you were a company doing, let's say, employee reference checks or insurance claim checks. By saving 30% of your workforce, your margin goes way up, and you can potentially acquire other companies, consolidate the market, and become very, very valuable in the process. So we actually think these traditional companies need to find a way to realize the value from AI. That's the lowest hanging fruit. So, and also I think the data that they have, I agree with Jim, if no one cleans it up, it's no good. But sometimes it's the work it takes is to clean up all the data, and sometimes it's create a new closed loop where the data becomes connected to the outcome. But in any case, I think, so in light of these problems, we've adjusted our investment strategy because we believe infusion into traditional companies, along with engineering talent, can dramatically increase the return. So we've actually built up a very big team of AI engineers who are not as good as these PhDs we're talking about. These are still very smart engineers. We train them in AI in 5 to 8 weeks, and then they can go work for one of these companies with our infusion, and then sharing the upside that they create. So think about this as like private equity, except you're not taking over the company, replacing the management team, but you're injecting an AI team and essentially acting as their chief AI officer and find the places in the business where there's the biggest bang for the buck. And we can now train 750 AI engineers a year. So we're now developing a new business based on that.
Fascinating. Developing your own internal talent. So it's an interesting quote that Eric Schmidt had about the rise of China related to AI. He effectively said that by 2025, China will lead in every dimension of artificial intelligence. Arguably today, they're leading in efforts related to deep learning, they're leading in efforts related to facial recognition, among others. Can you touch on the factors that are contributing to that? We've got the Bay Area here in San Francisco. We've got this other Bay Area, the Greater Bay Area, with 70 million people from Shenzhen to Hong Kong to Macau, et cetera. Jim, can you touch on, you're invested across border. Can you tell us about some of your work, both in the US and China, related to AI?
I think like so many investment and financial topics, it's far more complex than I think even most entrepreneurs, investors, and academic leaders know. My take in terms of where we are today is that 80% of the breakthrough AI innovations will be in US, China, China and the US. And there are some in India. UK has some excellent AI talent. Of course, the DeepMind people came from the UK. Toronto, Montreal are deep centers. But I'll focus on one area within medicine. Computational pathology, which is an area where I think there will be initial very big outcomes. There are several companies that have been backed, including one that I backed and spun out of Memorial Sloan Kettering, which is a whole other story over later drinks and cocktails, but it is extraordinary how differentiated prostate and breast cancer data is at many of the very best academic centers in the US. So it's not going to be in China, number one is my thesis. And even many of the very best medical schools and hospitals in the United States have not been digitizing the slides or the annotations. And so one of the remarkable opportunities for the United States and for all of us as investors, patients, doctors, academic institutions, healthcare providers, digitizing the data in a readable form, having different cancer centers work together, having the medical schools work together, and then even cross departments within many of these schools and hospitals work together. Now, it seems so easy, but if we take the New York hospitals or the Bay Area hospitals, there is very little cooperation between departments in areas like pathology. That will change, but the silos need to be broken down. And in the world of academic institutions where I volunteer and spend a lot of my time, the silos are enormous. As those silos decrease, there are areas, I believe, where the US is far and away best in world, and there's machine learning and computational talent. So if we're able to break some of these silos down, get academic institutions and medical institutions and general practitioners and academic specialists and the leukemia and cancer specialists working together, which is no easy feat. But if we're able to do some of that, there's no opportunity elsewhere in the world where the opportunity to generate great investment returns and make a fundamental difference for patients, for doctors, for all of us who are part of the healthcare system. There's no other place in the world where the opportunities are what they might be in the US, in my humble opinion.
So in China, 8 out of 9 politicians are engineers, mechanical, electrical. Xi himself is a chemical engineer from Tsinghua. And there's about 5 to 6 times the amount of software engineering graduates coming out of China per year as there are in the US. Can you explain to us how China is going to eat our lunch?
Well, the top researchers are all American and Canadians, right? If you look at all the Turing Award recipients, the inventor of deep learning, there's almost zero Chinese presence there. So the fundamental advantage of US is at the very, very top of the pyramid, the super scientists, leaders, their US is dominant in this space. But as you go down the pyramid into decent AI researchers, China probably occupies a half. If If you go into entry-level AI engineers, China has a lot more than US. And then if you just count the number of engineers, China is 5-6 times larger than the US. So I think the research excellence and leadership will cause US to have the most likely next scientific breakthrough. And that's the US fundamental advantage. But China has the sheer numbers of engineers who work incredibly hard, and there's a lot of data which is easier to gather, also more users in China. So that's the China advantage.
So I remember a few years back, we brought yourself, Kai-Fu, and a number of your portfolio companies to Silicon Valley. And after the week or so, we had a brief conversation. You had mentioned there were 2 key points.
Yeah.
Point 1 was that Silicon Valley seems to still be a hotbed of innovation and vibrancy and creativity. But point 2 is, wow, these people are lazy. Coming in at 10 a.m., leaving at 4, they're on the colorful Google bike, they're getting free food, et cetera, et cetera. Can you kind of compare and contrast the entrepreneurial vigor, say, in Beijing versus that of Silicon Valley? Jim, what's your thought on that?
Boy, it's the first time I've heard Silicon Valley technology leaders are lazy. I'm laughing and smiling. The intensity in Silicon Valley, like in the very best investment firms in New York, the very best manufacturing supply chain companies in southern China, the intensity is extraordinarily high. I think part of the challenge for all of us as investors and leaders and board members, volunteers in hospitals or museums, whatever it might be, we are at a stage where the technology, the intensity is moving so quickly that there is no industry that is unaffected. I was on the board. I love entertainment. Disney's bought 2 of the companies that I've been on the board of, Marvel Entertainment, and most recently 21st Century Fox. And scale has just been redefined in media and film. And Disney and Bob Iger, who's one of the great executives of the world, as is Tim Cook, and I could go on, Jeff Bezos, Sheryl Sandberg, Mark Zuckerberg, the concept of scale has changed so dramatically in the last couple of years that I think we're still trying to understand what that means. I have never seen an instance where, as companies grow in size or assets under management, if we take Bridgewater or Blackstone or Disney, excellence, persistent returns often are there as these companies scale. And a lot of that is because of the enormous talent of technology and a culture, in each case perhaps unique, that marries that. And so I don't know where we are in this evolution, but if we take the 20 top market cap companies in the world, they're scaling faster than anything I can remember. In private equity and hedge funds, Bridgewater and Blackstone and many of the quantitative hedge funds are scaling dramatically and delivering excellent performance. And that's true in the media business. That's true in a number of other areas, e-commerce, of course. And so suddenly you have Walmart, where I was on the board for 10 years plus, saying, we don't have the scale to compete with Amazon. We have to find ways to incorporate technology in so many different ways so that we can achieve some of the scale that currently Amazon exists and is building. And obviously, Netflix had a huge influence on where Disney, 21st Century Fox, and the media companies are. And we're just at the beginning, I think, of understanding how it is that exceptional shareholder returns, financial returns, are at the same time being driven by the companies that are scaling assets or technology the fastest.
So I want to change topics a little bit, So there's a lot of people here from the hedge fund community. And while AI is infecting a multitude of problems in the private sector and in private markets, it's also affecting public markets. So last year, for the first time, there's now $1 trillion of assets run by quantitative hedge funds, like the Two Sigmas of the world or the Renaissance Technologies of the world. And it seems to be an arms race, a bit of an AI arms race in the hedge fund ecosystem. I'm wondering, what are the ramifications on the markets long term? Is efficient market theory something that could perhaps happen at scale? Kai-Fu, do you have any thoughts on this?
Well, my views are rather extreme on this, so please don't feel offended. I feel the job of selecting stocks is not a job designed for humans because it requires absorption of absolutely infinite amount of data from recommendations, reports, people's points of view, newspapers, social network, understanding global competition, geopolitics, and no human manager can absorb all of that. Furthermore, I know some funds say, well, we're going to just focus on this sector or pick these stocks. Well, but all the stocks are equally selectable. And I think all that information with deep learning, it's the first time ever you can feed a multitude of input, all kinds of different things into a network and have it do really smart decisions. And quantitative and also trading is very much driven, outcome driven. There's nothing more outcome driven than the price of a stock. You want to have an engine, deep learning, to maximize its ability to predict the stock tomorrow, next week, a month after, and then you do it all over all the stocks, and you have some way to manage the whole solution. So this is almost a perfect problem designed for deep learning. So why hasn't that happened? It has, but when you put all of the AI, potentially AI-driven systems as quant, that's not a fair characterization because most quant have no AI in them. They're more competing on arbitrage or time or speed and things like that. But interesting, you mentioned Two Sigma and Renaissance. I'm friends with both CEOs. I went to school with one of them, and the other was my contemporary at MIT, both PhDs in artificial intelligence. So these two funds' performance should give you a strong hint that is the future. And also, what gets fed in is absolutely not just the stock, just the technical signals from the last day. It's really everything that you can read and hear, all the spoken and video and everything can be fed in. So what happens when every fund, so today these funds, they come up with strategies, and then there's other funds who try to reverse engineer their trades. So sometimes, so they have to keep inventing. So these two funds continue to do significantly better than the market. But one could ask, well, over time, what if everyone becomes equalized? Of course, the market cannot go up, be 4 points higher as a result. But I think it then comes back to the talent point that Jim was bringing up. These two funds have been recruiting people from Google. They hire more people from Google than the other way around. So it's really a talent game. And I think we're going to see a lot more breakthroughs. I think the access to true AI, deep learning technologies are simply unavailable in most hedge funds. And those who don't embrace this soon, I think will face significant consequences.
I think it very much depends on the asset category, of course. So if we take real estate,
sure. Yeah.
There are certain illiquid classes of investing where there is just a domain expertise and a talent that is extraordinary. So we talked earlier, fortunately, being on the Blackstone board, our new president, John Gray, is gifted. He has scaled real estate investing in a way that is breathtaking. And so I still think in many illiquid classes of investing, marrying that expert, someone who just has that intuitive sense of investing and returns with the extraordinarily important quantitative and AI tools. That, whether it's real estate investing, certain other illiquid categories of investing, medicine, that domain expertise is still really needed. But it's the best of the best in terms of domain expertise. And again, I think combining the best of the best with the top machine learning talent, and an understanding that both have to coexist. And so many of the early stage AI companies that I've invested in, so much of the challenge is pulling together the great domain expert who may be a Nobel laureate chemist with a biologist, with a neuroscientist, and 10 ex-Google genius 29-year-old machine learning experts, and culturally agreeing on operating plans and objectives and what needs to get done. So there's still wonderful right brain, left brain, that interaction absolutely needs to occur in the very best startups. And that's, I think, where the most compelling, interesting alternative investment opportunities might be, where you pull together that domain expertise, but there's a recognition, as Kai-Fu said, you better be pulling together tremendous AI, machine learning, data science talent at the same time, and ensuring that there's a common set of goals, objectives, and operating outcomes.
Definitely. So, you guys are invested in hundreds of companies over your career. Is there an investment in your portfolio today, whether it be in the US or China, where you can see on a 10-year or so time horizon, this company turning into a $1 trillion market cap company? Can you give us a hint of what the future might hold in both of your portfolios?
You have a few that are already close, right?
Well, their $1 trillion market cap is large. I smile because I have absolutely no ability to predict what market caps look like for the very best companies 7 to 10 years from now. But I will say of the top 20 market cap companies in the world a decade from now, 18 will be in the US and China. They will have technological underpinnings. We're going to get surprised by a couple of the companies that we would not think of today. But I would not be betting against Alphabet, Apple, Microsoft,
The big guys.
Amazon, and others. They have so much talent. They're founder-driven. They are on the edge of recruiting the very best PhDs. They move like lightning. And therefore, I think there's a tremendous opportunity of those likely to be trillion-dollar market cap companies to have a very decent representation in that category within the FANG bat stocks of today.
And Kai-Fu, will give you the last word. What trillion-dollar companies are in your portfolio right now?
I'm not sure we have any, because we have a very different metric, right? We look for the greatest multiples to our shareholders. So if something brings 100 or 1,000x, we'd be very happy with that. And if it can become $1 trillion, that's probably 10 years after the IPO. So it has nothing to do with our investment anymore. So probably what we're most proud of is that in the early phase of AI, where it's kind of a rocket science, we were the first to invest in AI. We found 5 unicorn companies. They lead in the areas of semiconductor, autonomous vehicle, AI for banking, AI for retail, AI for manufacturing. So we kind of got them all. So we collected the whole set. And I think we're now in the business of AI infusion to help businesses create value by putting AI engineers and investments in them. Probably there will be another set of 5 to 10, either unicorns or 100x plus returns. And that's what's important to us. It's on the $1 trillion companies. I basically agree with what Jim said.
And I know we have 5 seconds or less for this current crop over the next 12 months of IPOs. The best advice I can offer, try to identify the leadership in these coming to market companies that resembles a team of Mark Zuckerberg and Sheryl Sandberg, or embodies a young Jeff Bezos or Tim Cook. It's the management, operational, strategic capabilities at the top that will be just as important as where the technological lead might be today.
And with that, Kai-Fu Lee and Jim Breyer. Thank you.
Thank you.
Thank you.